Welcome back. Well, the stock markets are under pressure, but they are not the only market that are under pressure. At the moment, the rupee is also at its 1 month low, 82.45, 82.5 thereabouts, and that's the level we last saw probably a month ago, Jan 5th or thereabouts. And that's because the dollar has strengthened a goodish bit, 103 plus, on expectations that the US Federal Reserve may not stop with just one more hike. It may be yet another because of the strong jobs data. Likewise, the Indian bonds are also showing higher yields, 7.32 on the 10-year bond, which is actually now 11-year, but we'll take that benchmark, 7.24 bond. And the reason why the yields are higher in the bond is, again, because global yields have gone up. So just to put that on the radar, the stock markets are under pressure, but the bank nifty is not under pressure. And that's very important. There have been some sterling numbers, and one of them is what we're going to discuss. Bank of Baroda posted a solid set of numbers with earnings growth of 75% year on year, and that's led by a 50% year on year growth in operating profit. Asset quality showed a further improvement. I think the gross NPL declined by almost a percentage point, 80 basis to be specific, over the year. And the net interest margin is also at a 30-year high at 3.37. Sanjiv Chadha, Managing Director and CEO of Bank of Baroda, with us. Mr. Chadha, good morning. It's very difficult to ask a difficult question. It's a good set of numbers. So let me start by asking you your guidance. I mean, do you expect to continue with this kind of loan growth? What's the forecast for next half year, next 1 year?
So thank you very much, Lata. So I think in terms of guidance, we have been guiding that from the next year, that is 23-24, we expect to post consistently a return on assets of 1% or better and a return on equity of 16% or better. Fortunately, we have been able to hit those targets now. So I believe now onwards, we should be consistently seeing numbers of that kind. To my mind, that is powered, of course, by the cyclical factors. Corporate credit costs are down. There's the advantage of lag effect when interest rates rise. But there's also a couple of factors which I think have worked particularly well for BOB. One is on the growth side. So I think even last year we were growing pretty much as per market. But this was when our corporate growth was tepid. And because we had to choose between growth and margins. And at the beginning of this year, we had said, look, now we expect it is possible to have both. So you'll find that a corporate growth now is at about 13%, contributing as much as everything else. So that's one. And retail growth continues to be very, very strong. So our overall growth of about 20% YOY in terms of loans is powered by 30% growth organic in terms of retail. So that's a trend now that has been there for quite a few quarters. We would expect that to continue. And that is because, again, the major segment in retail, home loans, was a bit slow for us. Now that's picked up steam. In fact, home loans is the slowest retail segment at 20%. Everything else is even faster. So I think the growth part, to my mind, is something of which we can be reasonably assured. The second part, again, which is important for us, is costs. So when everything is improving, growth will happen. But for us, costs, again, have been growing appreciably slower as compared to the top line. In fact, the average increase in cost for banks is about 16%. For us, it is half. And that's in large part due to, again, the efficiencies that came in after merger. We had a very aggressive branch rationalization program. We hope to realize synergies of 10,000 crores over 5 years. That's working almost to a T. So I think this is a time when we can be fairly positive that the trend that you see now are likely to continue.
Okay, well, if you can give a more precise number for loan growth, I think you did 19.5. So for the year ahead, next 12 months?
So our guidance has been that in terms of priority list. First priority is underwriting standards. Second is margins. And third comes growth. Now, I think because of the benign credit environment, credit costs are coming down. So I think we can be a little more reassured in terms of underwriting standards and credit costs. And also in terms of margins, I think now the margin seems to have stabilized. So I think we would still guide that we would want to grow at market or better. My own sense is that there'll be a little bit of a moderation of the growth we have seen this year. If we are looking at a nominal growth rate of 10.5% as per budget, normally it is a bit understated, should be a bit better. and say multiply it by 1.25 or 1.3, I think 15% is the growth I would expect for loans for the industry, and we'd want to do there or a little bit better than that.
Okay. Well, let me first ask you the Adani questions and then come back to your bank because there's plenty others to ask. You have said that your exposure is less than 1%. What is the exact exposure? 5,400 crore.
So actually, the way we have been looking at is exposure again is computed in various ways, right? The most reliable way to compute that is as per the LEF guidelines of Reserve Bank, which takes into account outstandings, non-fund based limits, undisbursed loans. So we have again disclosed that our exposure is less than a fourth of what is allowable under the LEF norms. A. B, again, it is not among the top 15 group exposures for us. And it has actually, as a percentage, come down over the last 3 years. So I thought it is very important, while it may not be possible to look at specifics in greater detail, but I think we owed a reassurance to our shareholders in terms of what is the possible downside for the bank. To my mind, I think quite apart from the fact that these are income earning assets, our exposure is very limited, and we're very comfortable in terms of that position.
Which specific companies, sir? Is it ports? Is it power, transmission?
So I think that's, I think, the advantage that comes with a diversified group, that even that limited exposure is spread over 8-10 companies which work in different areas, the largest percentage being operating companies with very strong cash flows, which is again a reason why we are very sanguine in terms of prospects as far as that is concerned.
What is large percentage? Would 75% be to profit generating projects?
Absolutely. I think that's how it would work out. And in fact, we had also further, again, disclosed that of the exposure that we have, nearly a third, 30%, is where, again, there's a joint venture with a public sector company or backed by a guarantee of a public sector company. So I think there are a lot of mitigations which are there in place.
No, you know, the group has a lot of, for instance, airports under construction. The Mumbai airport will eventually start. You know, have you underwritten or agreed to loan for any of the projects that are under construction at this point in time? 25% would be that, you think?
So let me again say that let me not get into further specifics. But
Okay.
If there were anything, a transaction of that size, I'm sure it would have been in the public domain.
Okay. Now, normally, how is it? Suppose you had agreed to fund the, say, Mumbai airport. Can you change your mind? How do these covenants work?
So I think the fact is that there are always commitments in terms of project design, in terms of project debt equity ratio, the fact that equity must come at least to some part upfront, after that proportionately. So I think in terms of projects, you tried, what is project finance? It is ultimately a way of making sure that all possible risks that you can foresee are mitigated, including the equity and execution risk, right? So as long, again, those parameters are in place, I don't believe there ought to be a problem. But again, we are, as a bank, not overexposed to project finance, very rarely in a lead in large projects. So I think that would so much more depend upon how the lead bank handles the situation.
And you were not called upon to give any performance guarantee when foreign banks, bought bonds or gave loans to the group?
So again, we are getting. So I think I have given enough color on the exposure
Okay.
to again possibly indicate that we may not be. It's unlikely we'll be exposed to these kind of situations.
All right, fine. No, I mean, these are doubts that keep cropping up in the minds of stock investors. So I'm merely presenting their doubts to you. Anyway, thank you for clarifying. I wanted to come back to margins. No, there's no taking away that deposit costs are rising, and every other day, even in railway stations, you see advertisements of people ready to pay 7%, 7.5% and more for term deposits. So is 3.37 margin a kind of peak? How much do you expect in the fourth quarter and next quarter in terms of margins?
So ultimately, really, it's two sides, right? One is, of course, in terms of how your resource costs are. The other is whether the environment allows you to pass on those costs. Now, last year, the challenge, of course, was that the environment with surplus liquidity was not conducive to passing on costs, which is why I explained to you we had been very conservative in terms of corporate loan growth. Now, I believe we have come to a stage where it is eminently feasible to make sure that you, again, protect your margins. Also, I think it's equally important to bear in mind that a large proportion of loans are priced at 1 year MCLR, right? So the repricing of those loans is over an extended period of time. The third thing which is important in our case is that you would have seen that the proportion of retail loans particularly again unsecured loans where we had a relatively small portfolio that's growing very fast at more than 100%. I expect that to continue to grow, and that also gives a very significant upside in terms of margins. So if you were to ask me overall whether we expect margins to sustain despite the inevitable increase in terms of deposit rates, which I think is also a good thing because it'll allow us to attract more deposits, I believe yes, I think we should be able to sustain these margins.
Oh, that's very good. We didn't hear too many banks telling us that. And finally, your loans, I mean, like you pointed out, you have done extremely well in retail. But, sir, 30% year-on-year growth in retail, 29.4 to be precise. It reaches an area where you probably could be giving riskier loans. Would you worry?
So actually, it is really to analyze the composition of the growth. So we have been outperforming the market by a significant margin in car loans, for instance, in education loans also, where we have built very good businesses. For us, the drag was really home loans, where we were growing again at market a little lower. I think with the digitalization and Bob world, the access that we have to the market has improved tremendously. And the home loan piece, which was really dragging overall growth, because that is 70% of retail loans, that has now moved up. So I think given the fact that it is not really a one-trick pony, right? You have education loans, you have unsecured retail loans, you have car loans, you have home loans, your mortgages. I think the fact that all of these are consistently growing at a good pace, to my mind, would indicate to me that we should be able to sustain a fairly good pace of growth. Having said that, I think I had also spoken last quarter that there was some demand which was, of course, exceptional, right, post-COVID. For instance, yes. I think last quarter, the YY growth in the automobile industry was more than 40%. Now, nobody expects that to continue indefinitely. So there will be a little bit of moderation, but nevertheless, in terms of retail growing much faster than the overall growth for us and our ability to outperform the market in retail, I believe that should remain intact.
Okay. Well, the market is pretty elated. Thank you very much, Mr. Chadha. The bank Nifty is down 0.25%, but Bank of Baroda is up about 1% in terms of share performance. And, a promise that we will be on return on assets above 1% is a big one. Investors won't miss that. We wrap up on Bazaar. Chartbusters up next.